Hello, everybody. It's Jeremy Whaley here from Trade Maestro. Hope you're doing fantastic today. And I want to talk about the difference in crypto candles, that is candlesticks that you see in your crypto charts, and the candlesticks that you see on your stock charts. There's a couple of very distinct differences. And if all you know is one style of candles, then the other style is going to mess you up. So we're going to talk about that. And I think you're going to learn a lot in this video. I will talk to you about all of that on the other side of the disclaimer. So let's go. And welcome back, everybody, to another video here. It's Jeremy Whaley from Trade Maestro. Hope you're doing fantastic today. As I said in the opening, I'm going to do a discussion today on the differences in crypto candles and stock candles. And there is a distinction between the two of these. Whenever you're looking at crypto candles, they have certain outliers, if you will, that are much different than the stock candles that you might be used to. Or if you're going the other direction, if you've been trading crypto and you're coming over to trading the stock market, then you're going to notice some really distinct differences. So let's get into that. Before we get into all of that, I want to encourage you to like and subscribe if you want to learn something. They say it is proven. The moment that you click the like button, the moment you click the subscribe button, you engage your brain to learn more. So go ahead, click the subscribe button or the like button right now, and let's get started. When we talk about candlesticks, I'm going to assume that you have a basic understanding, but I'm just going to hit on a couple of high-level principles here just to make sure, in case you're brand new, we're all on the same page here. So there's two parts to the candlestick. There's the body and the shadow. The body and the shadow. And you can see on the bottom portion of the screen here, a white candle. You see that big white chunk, that big white square in there. And then on the black candle, you have the big black square. That is the candle body. And then the portion that is above it and below it, that is your candlestick shadow. And the way that these are constructed is the upper and lower shadow is going to be drawn to the upper shadow is going to be drawn to the high price of the day. The lower shadow is going to be drawn to the low price of the day. And then the candle body is going to be the distinction between the open and the close, okay? And the way that candles are drawn, if it's a higher closing price than an opening price, then we draw the candle up and it's not shaded. And that's why it looks white. It looks white on a white background. But if you put it on a black background, it looks black, or a blue background, or whatever color. So the idea is it's actually hollow. And then the black candle is actually shaded in, it's colored in, and that's going to have the lower closing price. So the opening price, and then it draws down to the closing price for the day. And that's how candlesticks are constructed. Again, just coming back here to my slide, you can see it drawn out here on the white candle. You have the opening price down here at the bottom of the white square. And then the high price of the day is the upper shadow, the low price of the day is the lower shadow, and then the closing price of the day is the top of the white square. And then over here on the black candle, you'll notice we have the opening price, high and the low are the same, but we draw down to the closing price, okay? Now, this is the way that candlesticks have been drawn for literally hundreds of years, a couple hundred years, going back to the mid-1700s, in some cases, maybe the mid-1600s. That's how far back the history of candlesticks goes. Back in the old days, it was all done by hand, obviously, because they didn't have computers. And they drew it all out. And the way it was drawn is the way I just described it. They drew a box that would define the open and the close. And whatever the background color was, if it was a white background, then it looked like it was a white candle. If it was a gray background, it would look like it was a gray candle. And then they would color in what we call the black candle. In today's charting, what is often done is that people often color them red and green. And if that works for you, then that's fine. I'm pretty old school. I learned candles 25 years ago. And the way that I've learned them is the traditional way. And so what I often do with my charts is I will actually invert them, and I still have hollow and solid candles. If I see green and red, my brain literally interprets that as shaded candles. The green candle looks shaded to me. So you'll always see on my charts, or almost always, unless something gets messed up, you'll almost always see it as a hollow candle and then a solid candle. But I do shade the outline of the candle to be green, and then the solid part is red. All right, so with that said, let's get into what the distinction is here. The challenge that we have with candlesticks is a lot of the multi-line candle patterns require a gap. Okay, so if you look at like the bearish engulfing pattern, dark cloud cover, most of these most of them, maybe not all of them, but most of the 2 candle line patterns or the 3 candle line patterns, you'll see a gap with it. Morning star reversals, evening stars, there should be a gap that's part of that pattern. But the problem is in a 24-hour market, such as a crypto market or such as a Forex market, or even futures to some degree, but definitely in crypto and Forex, in intraday, that's the other thing, is you'll see the same challenge on an intraday day trading chart, okay? So if it's a continuous chart, we'll just call it a continuous chart, then you're not going to have the gaps. And so what happens is candle patterns such as this one here, this is a bearish counterattack. And what you're going to notice here is on this chart, you have three lines just going up. That doesn't mean anything. It's just the direction of the trade. And then here's the pattern. It's the white candle. We close up here at the top, if you can see where my cursor is. Close up here at the top. And then it gaps all the way up to the top of the black candle, and then it trades down. Okay, that is where the problem shows up. And so if we want to solve for this, how do we solve that? Because in a 24-hour market, you don't have a gap. Gaps only happen because the market closed and then it reopens at a higher price or at a lower price. It's the only way that the gap happens. So it's not going to gap more than a tick or two. It's not going to gap between candles if it's a continuous market. So how do we adapt for that? And the answer is we have to adapt our candle patterns so that they don't have gaps on the chart with a continuous market. So let me show you about that. I'm going to come over here to our charts and we'll get into TradingView here. And let me just set a couple of things up. What you're looking at right here is a typical stock chart. I'm going to get rid of all these lines, even though we have a bunch of trade setups on here. Let's just get rid of all of that. In fact, let's just go to a totally different chart. There we go. And I'm even going to get rid of our indicators for this particular example because it's not going to give us a whole lot of relevant information. And what I'm going to do is I'm going to come down here to a couple of turning points where we can see some really good candle formations. Now you're going to notice on here the way that I have drawn my candles. I do have the green candles, but I've almost got the middle of the green, and I don't know how well it's translating for you in the video, but I've almost got it completely translucent. So you see the solid green outline, but I have it hollowed out. That is the only way my brain will interpret it. If it's a solid green candle, my brain literally thinks it's a solid candle. So anyway, take a look here. Notice on this red candle, we closed down here, and then we gapped up to here. You see that little gap right in there? That little gap right there creates a candle pattern. That 2-day candle formation is called a one white soldier. Now, doesn't look white, but that's the traditional pattern for it, okay? This one back over here is another one. We closed here and we gapped way up here, and then we traded down. That is a bearish counterattack formation that you see forming up in there. And I can just go from turning point to turning point, a bunch of these candle formations like this one right here. We closed up here. Close right up here, and then we gap down to here, and that is a bearish harami candle, which typically stops momentum, and we see that's exactly what happened here. But in order for it to be a bearish harami, you have your open hollow candle, and it gaps down, and the next candle is inside the previous candle, just like you see right there, okay? So if you've traded stocks at all, you understand this if you've ever dealt with that. Now, when we come over to crypto, let's come over to a Bitcoin chart here. And what you're going to notice with crypto is you don't really have that, okay? So let's just start at the bottom down here. Okay, this little formation right here, in a crypto world, that's called a morning star reversal. In the stock world, it's not. In the stock world, that's nothing because there's no gaps to it, okay? But you notice what happens. We close here, we open right there, we keep trading down, we close, we open right there, we trade down, we closed right there, we open right here, we trade up, close here, trade up. It's a continuous market. There are no gaps. Okay, and crypto is the most pronounced of this because crypto truly trades 24 hours. At least Forex closes on the weekend, so sometimes you'll have a gap on the weekend. And in crypto, it's a true 24-hour market. It's just trading all the time around the clock. So you don't really have gaps on your crypto charts. And what that does for your candlesticks is it makes for a really potentially confusing set of patterns, especially if you're used to interpreting candlestick patterns the traditional way. So what I want to show you over here, if I can get back to my full screen, what I want to show you is just how we would interpret some of these patterns. And I'll just kind of take some random ones, whichever ones show up here. I don't really have a plan for which ones we're going to look at, but I'm going to highlight up in here this turning point up here. Notice, for example, this 2-day candle formation. How do you classify that formation? We opened down here on the green candle. We closed up here. We opened in the exact same spot on the red candle. We came back down, and it went beyond the green candle. Well, in a traditional stock trading scenario, you have your moves, and then you had a green candle, or in this case, on the chart, it looks like a green candle. Here, it's like a black candle with a blue outline. But let's say you had that, and then it would gap up and trade down. We would call that an engulfing candle. Okay, that whole formation right there, that would be a bearish engulfing. Very, very bearish signal. Well, you can't have the gap up because it's a 24-hour market. So this here, I would call that a bearish engulfing, BE for bearish engulfing. Okay. Another thing that I want to say about this is this pattern where you have candles with the same highs, there actually is a pattern name for it. It's called a tweezer top. But the problem with tweezer tops or tweezer bottoms is there's a million, not really a million, but there's a bunch of variations of them. So what I'm going to show you right here as we go through this is how you can kind of superimpose the traditional stock formations onto this 24-hour market, okay? So this is one example right here. That's a bearish engulfing formation, and it stopped the move. We did make intraday. We made a little bit of a higher high here, but that stopped the move. Next thing you know, you have a cycle that's going to the other direction. And by the way, that's what candles do. Candles give us sentiment indications, sentiment signals, if you will, of where the momentum is going. Take a look through here. This would be a bearish harami. It doesn't gap down, but that's a bearish harami. It's a totally inside day. Okay, now you notice that intraday we traded higher, and that's okay. When we look at 2-day or two candle formations, what you're looking for is you're looking for the bodies for the most part. You're looking for the bodies, not the candle shadows. Single day candles, shadows matter. Occasionally there's some other patterns where shadows matter, but for the most part, your patterns of two-line candles are all about the body. So here's a good example of that where we're inside the previous day. If this had been a regular stock candle, the odds are it would have gapped down. It would have been stuck inside there. So on a stock candle, it would have looked something like this here, probably would have gapped down. You would have had that inside day, and that would have been your bearish harami. These lines I'm drawing to the left, that's just showing the momentum, the direction getting there. So that would be a bearish harami candle. Bearish haramis are definitely a bearish pattern, but it's not the most bearish formation. It tends to slow down and anticipate a reversal. Well, we got that here. You can see through here that we slowed down. We went ahead and put in just a slightly higher moves. And up here, here's another bearish harami right there. You see that little bearish harami inside there? It's inside. It gets tricky. That's the whole purpose of doing this video, is it gets tricky. If you're used to looking for that harami totally inside the candle like you see with stocks, you're not going to see it in crypto. Then here's an example of a Morningstar reversal right there. Very typical Morningstar reversal. I'll make it full screen so you can see it. But you notice there's no gaps in there, okay? And gaps are part of a morning or an evening star reversal. Let's go to some more reversal formations. We have some spinning tops and dojis up here. And then here's actually a pretty typical engulfing formation like you would see on a crypto chart. Okay, that's a very typical crypto bearish engulfing formation. There's no gap up. It just picks up right here and engulfs the previous day. So you see how that took place there? And so I hope this is really helpful for those of you who've been stock trading and you're trying to make that transition over to crypto. You're just going to have to know that when you're looking at your crypto charts, they're going to look a little bit different. There's several other distinctions, and I'm going to start doing a series of videos here that kind of compare stocks versus crypto so you can kind of start to make that transition. But this is one of the most obvious ones. If you are one of my students who's been using candlestick charts for years and you're used to this, then this is going to be a big change for you to get used to seeing candle patterns that are not gapping. Because you've probably been using my flashcards and all those other things that teach you all the patterns, and then you come over to a crypto chart, you're like, they're all tweezers. There's no gaps. Well, it's a 24-hour market, and again, it's not just in crypto. It happens in forex. It happens in day trading charts. It happens anywhere that you have a continuous chart. So I hope this has been helpful for you. I hope it makes a lot of sense to you and gives you some insights. You just have to practice it. Just have to work with it. Your patterns essentially work the same. You just have to take the gap part out and fill in the other portion of it. And outside of that, it's pretty much going to be the exact same pattern that you are used to with your candlesticks. If you got some good stuff out of this, then guess what? It's time to like and subscribe. Like and subscribe because I got a whole lot more that is coming for you. Lots of videos on the way. And if you haven't checked us out over at trademaestro.com and you want to learn some more, then please come over to trademaestro.com, take some of our free courses, or obviously, if you're ready, sign up to be a member or sign up for our accelerator course where you can really learn to take your trading to the next level. All right. Thanks again for being here. I hope you've got some great stuff out. I don't see you in the next video. Until then, happy trading. We'll talk to you soon.